In the fast-paced world of cryptocurrency, regulations are poised to be a transformative force that will reshape the industry as we know it. As governments and regulatory bodies awaken to the disruptive power and growing popularity of digital currencies, a new era of oversight and guidelines is drawing upon us. These forthcoming crypto regulations hold the potential to unleash a wave of innovation, stability, and mainstream acceptance, setting the stage for a more secure and inclusive financial landscape. In today's video, we will delve into those regulations and policies that will change the crypto world and assures investors that the funds are safe. But first, let's look into what is happening in the crypto world. There has been severe turmoil and disruption in many parts of the crypto asset market recently, and by repeated cycles of rapid growth and the retreat of the crypto ecosystem. During times of stress, we have seen market failures of stablecoins, hedge funds, and exchanges, which have raised serious concerns about market practices, client protection, and where interlinkages with the core financial system are deepening. For systemic risk oversight and financial stability, many of these concerns can be addressed by strengthening financial regulation in this area, and by developing global standards that can be implemented consistently by national regulatory authorities. The US Securities and Exchange Commission, SEC, is leading the charge in subjecting cryptocurrency markets to comprehensive financial regulations. SEC Chair Gary Gensler has emphasized the need for top exchanges to register with the SEC and comply with relevant laws, as he believes they may be engaged in trading securities. Additionally, Gensler called for increased enforcement of financial regulations regarding stablecoins and other crypto tokens. To bolster regulatory enforcement, the SEC announced the expansion of its cyber unit in May 2022, increasing staff numbers and renaming it the Crypto Assets and Cyber Unit. This expansion signifies a significant step towards strengthening the SEC's ability to enforce regulations in the crypto space. As a result, fundamental changes in how cryptocurrency markets operate are expected. Here are 3 key changes to anticipate shortly. First, new tokens may face regulation. The US Securities and Exchange Commission has been actively enforcing securities laws in the cryptocurrency space. During the initial coin offering boom in 2017, the SEC classified DAO tokens as investment securities. In 2020, the SEC sued Ripple Labs Incorporated and its executives, alleging violations of securities laws related to the scale of XRP tokens. Many ICO issuers have also faced fines or settled out of court. Although the SEC has primarily focused on ICOs, new types of tokens have emerged, such as decentralized finance and non-fungible tokens. While some of these tokens may appear to bypass security laws due to their decentralized nature or collectible status, they can still be subject to securities laws if sold as investments. In August 2021, the SEC settled its first enforcement action in the DeFi space with the DeFi money market over unregistered securities sales. In February 2022, BlockFi Lending LLC settles with the SEC and states for failing to register its interest accounts as securities. NFTs may also face scrutiny under securities laws, and the SEC has reportedly issued subpoenas to NFT creators as part of its investigation. SEC Chair Gary Gensler has stated that most crypto tokens likely qualify as investment contracts under the Howey test, which defines securities as investments with an expectation of profits derived from the efforts of others. While the SEC has not yet announced enforcement actions specifically targeting NFTs, its involvement in the space indicates a potential expansion of securities regulation. Also, exchanges may have to register as broker-dealers. In a hearing before the Senate Banking Committee in September of 2021, Gensler said crypto exchanges should have registered as securities exchanges. He repeated the call in April 2022 that these crypto platforms are playing roles similar to those of traditional regulated exchanges. Thus, investors should be protected in the same way. Crypto exchanges have been historically opaque, allowing their operators to generate profits without regulatory oversight or accountability. Many exchanges have been accused of wash trading, front-running, or freezing customer balances. If registered with the SEC, crypto exchanges would be forced to adopt technology systems to make their order books audit compliant. They would also face strict rules on order execution to prevent market manipulation. In his speech in April 2022, Gensler highlighted the exchange's crypto custody issues as another concern following thefts of more than $14 billion in crypto assets in 2021. In the past, many exchanges have chosen to avoid US regulation by locating abroad and rejecting US customers. However, many exchanges accept compliance as the cost of access to the lucrative US market. Some cryptocurrency exchanges, such as Coinbase, have sought to comply with SEC rules by acquiring US-registered broker-dealers. Additionally, stablecoins may face greater scrutiny. Another likely focus for regulators is the proliferation of stablecoins, blockchain tokens whose value is pegged to the dollar or another fiat currency. Most stablecoins back their peg by keeping large reserves of cash, treasuries, or other low-risk assets. The May 2022 collapse of the Terra or UST algorithmic stablecoin has heightened concerns about other stablecoins and their regulation. Backers of Tether or USDT, the largest stablecoin, paid $18.5 million in a settlement with the New York Attorney General in 2021 and incurred a $41 million fine by the Commodity Futures Trading Commission the same year over allegations they misrepresented its reserves. Tether now publishes limited details about its reserves holdings daily. Gensler asked in April 2022 what backs these tokens, so they can make sure that these holdings can be converted to dollars one-to-one. Stablecoins may pose systemic risks to the crypto ecosystem and beyond, while facilitating money laundering and sanctions evasion, the SEC chair added. Since the SEC considers crypto exchanges de facto securities brokers, it is also likely to view most stablecoin trades as securities transactions. Although the SEC has not yet launched litigation, the regulator has indicated that it may be among the government agencies probing Tether. But how can the crypto world be stabilized? Crypto assets, including stablecoins, are not globally systemic, but in some emerging market economies, they might be on the verge of generating risks to financial stability. Some of these countries are seeing large retail holdings and cryptoization, or currency substitution, by crypto assets. Cryptoization has the potential to lead to capital outflows and a loss of monetary sovereignty, thereby creating new challenges for policymakers. Authorities need to address the root cause of cryptoization to improve trust in domestic currencies, in the domestic banking system, and in domestic economic policies. Advanced economies are also potentially susceptible to financial stability risks from crypto assets, given that institutional investors had been increasing their stablecoin holdings, attracted by higher returns on DeFi platforms, in what had been a low interest rate environment. This is why regulatory authorities must move quickly to manage the risks that crypto assets generate, while not stifling innovation. To stabilize the crypto market, we need to first license crypto asset service providers. Crypto asset service providers delivering critical functions should be licensed, registered, and authorized. Such entities include those providing storage, transfer, exchange, settlement, and custody services. Rules should be similar to those applying to providers of these services in the traditional financial sector. Licensing and authorization criteria should be articulated, the responsible authorities clearly designated, and coordination mechanisms among them well defined. Also, stablecoin issuers should be subjected to strict prudential requirements. Some stablecoins are starting to find acceptance outside the crypto space, and they have the potential of becoming widely used payment instruments. As such, they look more and more like money. If not properly regulated, stablecoins could pose serious challenges to monetary and financial stability. We need strong bank-type regulations for stablecoins, and central banks should take the lead in such an endeavor given stablecoins' potential presence in the monetary system. Lastly, there should be clear requirements for regulated financial institutions concerning their exposure to and engagement with crypto. If regulated entities provide custody services, requirements should be clarified to address the risks arising from those functions. And there is a need for robust, globally consistent, comprehensive regulatory responses to achieve effective crypto regulation and supervision. The cross-sector and cross-border nature of crypto assets limits the effectiveness of uncoordinated national approaches. For such a global approach to be effective, it must also be adaptable to a changing landscape and risk outlook. More generally, we believe that targeted restrictions could deliver better public policy outcomes provided there is sufficient regulatory capacity. For instance, they can restrict the use of certain crypto derivatives, as shown by Japan and the UK. They can also restrict crypto promotions, a step taken in Spain and Singapore. Alright guys, that wraps up our video for today. If you enjoyed watching this, please don't forget to give us a thumbs up and hit the like button to see more. Thanks for watching.